Very good evening to all of you. Welcome to another YouTube live session with me, Surjit Kakkar. Today we are on lesson number 17 for our options course. So we have already covered a few of the Greeks. We have already covered delta. We have already covered theta. Today we will be talking about Vega. Now, before we move ahead with the session, let's get done with the formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, like I already said, we are on lesson number 17, and I'm doing this option course as an absolutely free course. In case you have still not gone through the previous lessons, make sure you do that. And the link to the playlist is available in the description for both English as well as Hindi language. And yes, if you're liking these sessions, please hit the like button, hit the thumbs up button, and if you have some friends, family members, or if you're on some trading group where people might be interested in learning options, you can definitely share the link with your friends and family and the trading groups as well. So yes, let's get started with our lesson number 17 today, which is Vega. So before we start with Vega, let's again do a quick recap. We talked about Greeks. So what is Greeks? The purpose of what is the purpose of using Greeks with option? So we talked about that the Greeks, they allow us to measure how parameters such like script movement, this is called as delta, which we have already covered. Time passage, this is called as theta, we have already covered. Today we will be covering volatility changes, which is basically the implied volatility, and eventually we'll also be covering interest rate change and other things, how they might affect the price or the value of the option. Now, Greeks, they give us a greater and deeper understanding of risk and the behaviors. And can you see, by understanding how the movement of the script behaves, we were able to choose better strike prices. Similarly, by understanding how the time passage behaves, we were able to understand what strikes we should be using and what expiries we should be using, right? So that gave us a better understanding of choosing the correct strikes and the correct expiries. So similarly, as we move ahead, you will see why we are choosing certain strikes and certain expiries so that we have advantage of all these Greeks whenever we are planning some options trade. So Greeks, they definitely make our life easier. That is the reason we are trying to understand these Greeks and how they behave. And Greeks are calculated by using theoretical option pricing model, which is based on the Black-Scholes model. And yes, by understanding Greek, we are trying to construct a much more fine-tuned position when we are uh, trading options, so that we are trading as a smart options trader and not just blindly going for cheap option contracts, which generally a lot of people they do, right? Because they don't understand the way all these things they behave. So once you understand how these things behave, you can always have a better position when you're using options versus just randomly buying any strike and any expiry. Now, talking about the Greeks, like I said, we will be covering a few Greeks. So, what are those Greeks? We have already covered the very first one, delta. This is the symbol of delta. And again, D stands for direction. So, that is how you can always remember that what is the impact of the script moving. So, if the underlying moves up or the underlying moves down, how would that impact the value of my option? That basically is dictated by delta. Similarly, the second one, this is the symbol. This is called as theta. T stands for time. So theta basically tells you the impact of time passing. So as and when the time is passing, because we know the options contracts, they have a certain expiry date. So every day, one day is passing. So by passage of one day, how much will the option value will be impacted? That is what is dictated by theta. Today we'll be understanding Vega. So again, V stands for volatility. Okay, just give me a second. Perfect. So V stands for volatility, and when it comes to options, if you remember when we did our lessons, which was historical volatility and implied volatility, historical volatility is based on the underlying, but the implied volatility is based on the options pricing, right? So this is where when we are talking about options pricing, we are basically talking about the implied volatility. So how would the change in implied volatility affect the value of my option, right? That is what Vega will dictate. And along with this, we'll also be covering gamma. So this is the symbol for gamma. Now G here, the very first initial, does not correlate to the meaning of it. It's just the change of the rate of change of delta. So this is the one you'll have to remember, that gamma stands for the change of rate, the rate of change of delta, because the delta is not changing at a constant rate. The delta also keeps on changing, and gamma changes the rate of change. And the last one is rho. The very first alphabet is R, so you can remember from interest rate that the impact of the change of interest rate. So as we move ahead, we'll also be covering gamma and rho. Today we will be covering Vega. We are already done with delta. We are already done with theta. Today we'll be starting with Vega. So what is Vega? Oops. Vega measures the change in the options premium given 1 point change. So 1 point change means 1% change in implied volatility of the underlying asset. So whenever we are looking at the options, we talked about options. They have something which is called as implied volatility, and we covered how this implied volatility is calculated. It is calculated by doing something which is called as reverse engineering, right? So we know the complete value. So again, how's Vega calculated? Example, if I know that A plus B plus C plus D is equal to, let's say, 100, and let's imagine D is basically my Vega. So I would know the value of A. So let's imagine A is 10, B is again 10, and let's imagine C is 10. And now I don't know the value of Vega, but I know the complete amount was 100. So now I know my D will be equal to 100 minus 30, which is 70. So this is how Vega is basically calculated, because Vega is actually your crowd psychology. So there is no way to gauge crowd psychology, but we know what the crowd is willing to pay. So when we know what the crowd is willing to pay, the other things can be calculated. So by calculating other things, whatever the leftover portion is, that becomes as your Vega. So just in case you've still not gone through the implied volatility session, make sure you go through it. You'll have better understanding of what is Vega. Now, what is the interpretation of Vega? Implied volatility changes the dynamics of crowd expectation, right? Because that is what we were talking about. If the crowd is calm versus crowd is panicking, they might be willing to pay extreme values for the same contract. So if we again go back to the example, which was the apartment example, that is where we talked about when the person who was selling the apartment, he had no information. He was willing to do that contract for, let's say, 5 lakh rupees, but when he had that information, he might increase his value to 20 lakh rupees. So can you see, from being very calm, now maybe not panic, maybe now he has over expectation. That is where he increased the value, and that is just because of his expectation. So due to which the value portion of the option premium inflates or deflates. So what is going to happen is, like we talked about, that the options premiums are made up of two components. One is the intrinsic value, the second one is time value. So the Vega, or the implied volatility impacts the time value portion of the option, not the intrinsic value of the not the intrinsic value portion of the pricing of the option. Now, Vega calculates the impact of these IV, the implied volatility changes, and helps us calculate the new value of the option. So, Vega will help us understand that what will be the new value of the option if there is 1% change in that implied volatility. If people they get more panicked, which means that panicness is increasing by 1%. So, what would be the new value of that option? Similarly, if people they start becoming calm and the implied volatility goes down by 1%, then how much the value of the option will change, right? That is what the Vega will tell us. Now, changes in implied volatility can have a greater impact on options premium than the effect of delta, gamma, theta, and rho combined together. Now, this is very, very important. Why this is very important? Because uh, implied volatility is basically crowd expectation, and crowd can have, or people can have, unrealistic expectation. So what can happen is, when we talked about options, we said options they have multiple dimensions. What are those multiple dimensions? You have delta, you have gamma, you have theta, you have rho, and you also have your Vega, which we are talking about as of now, which is implied volatility. So if all these are going in your favor, right, all these are going in your favor and they're making some money for you, if implied volatility starts going against you, whatever money you're making on all these Greeks, this can give you much a bigger loss versus whatever you were making on this. So this is what it means, that the change in implied volatility can have a greater impact. So maybe, all these combined together were making 5 rupees for you, but this going against you can even go maybe 20 rupees against you. So this is why it becomes very, very important for us that whenever we are planning our trades using options, this is the very first thing we have to control, because this can go to extremes, because it is crowd psychology. People can be in a very calm mode in a fraction of a second. People can get into a very panic mode in a fraction of a second. So this can vary to extremes, and that is why it becomes very important for us to give the maximum weightage to implied volatility whenever we are planning trades. The other factors, yes, are also important, but this can take away everything which all other dimensions are making for you. So this is why this point is very, very important. You need to remember that the implied volatility change can have a greater impact on an options premium than the effect of delta, gamma, theta, rho all combined together. So all other factors working in your favor, just one factor going against you can convert a winning trade into a losing trade. That is how fast the implied volatility can affect the premium of an option. So very, very important. So that is why when we did our lesson, which was when to buy options, when to sell options, right, we were focused on how to gauge whether the implied volatility is very cheap, fair price, expensive, or very expensive. Because unless and until we have that clarity, we would not know whether we should be buying options or selling options, right? So this is the most important thing you have to take in control, because this is more like the wild animal. So you'll have to control this. If this is in control, other things are not as crazy as the implied volatility can get. Now, that is why it is so important to apply the volatility method properly and decide about the optimal strategy to be used based on the analysis. So now when we talk about Vega correlations, right? So we have talked about correlations in the past many, many times. We talked about there can be two kind of correlations, a positive correlation and a negative correlation. So what is a positive correlation? Positive correlation is if the underlying goes up, the premium goes up, right? And similarly, if the underlying goes down, the premium goes down. That's a positive correlation, that whatever the underlying is doing, the premium will do exactly the same thing, right? And what is a negative correlation? Negative correlation is basically the opposite. If the underlying goes up, the value goes down of the premium, and if the underlying goes down, the value of the premium goes up. That's a negative correlation. So if you talk about Vega, Vega has a positive correlation, be that calls or puts, right? So Vega will always have a positive correlation to the change in implied volatility. So what is going to happen? When we are buying options, Vega is always positive. Why? Because we have a positive correlation. So plus plus is always plus. So if the implied volatility, so because it has a positive correlation, so what will happen if the implied volatility increase, the premium would also increase. So implied volatility increasing would increase the premium, because if IV is increasing, the premium will also increase. That's a positive correlation, and that is good for an option buyer. Why? Because if I'm buying options, I want the premium to increase, because if I buy it at a cheaper price and then sell it at an expensive price, I can make money. So whenever you are buying options, the Vega is always positive, and which means implied volatility increase would increase the premium. Similarly, whenever you are selling options, right? So we said we have positive correlation. So positive correlation, and because we are selling, plus minus is minus. So what will happen now? That Vega will be negative. So what do we mean by that? That implied volatility decreasing will decrease the premium, and that is good for an option seller, because if we are selling options, we want the premium to decrease. The faster it goes to zero, the better it is for us. So that is why when you're buying options, Vega is having a positive correlation. When you're selling options, no, I won't say it has a correlation. So when you're buying options, Vega will be positive, and when you're selling options, Vega would be negative, right? So that is what is going to happen. All right, so as an options trader, again, very important, we do not have preferred strategies. Instead, we adapt to the market conditions, selecting the optimal strategy. So that is what we will be learning as we move ahead, that based on whatever the market conditions are, which will be the best strategy to be applied at that particular given point of time. It's not that you will have some preferred strategies and every time you'll be using those strategies. So depending upon how the implied volatility is, we will choose the best strategy for that particular condition, and those are the strategies we will be applying. All right, so now let's understand the effect of Vega. So the greater the time to expiry. Now here you can see the strike price is exactly the same for all of these. Let me change the color first. right? So if you look at the strike price, can you see the strike price is 9100, but we have different expiries, right? You can see this is May, 21st of May, 28th of May, 4th of June, 11th of June, 18th of June, 25th of June, and then 30th of July. So what is happening is strike is same, but now we have more time to expiry. So the greater the time to expiry, so this is why I have taken examples where the time to expiry is getting bigger and bigger and bigger. So the greater the time to expiry, the greater the time value. Why? Because we know we have more time. So here you can see, if you look at the price, can you see the greater is the value of that option? And the greater the time value, the greater the impact in change of implied volatility. So what can happen is, the closer we are, because the value is very small, so Vega cannot change the value a lot. But if we have more value, right, more time value, then Vega will definitely have a bigger impact. So here you can see that if I look at the 21st of May, the Vega is just 0.97, and if I look at the 30th of July, Vega is almost 16, right, 15.92. So this is what you need to remember, that the greater the time to expiry, right, which will basically mean the greater the time value, and the greater the time value, the greater will be the impact in change in implied volatility, right? So the when the implied volatility will change, it will affect the value of the option uh, to a greater extent. Similarly, the greater the time to expiry, the greater the Vega, right? So that is what we just talked about. Now, if you look at this example, the 21st of May at the money provides a Vega which is 0.97 versus a Vega of 15.92, which is provided by the 30th of July expiry. So because we are further away, the time value will be big, and because the time value will be big, the impact of Vega would also be bigger. Now, if we talk about in the money and out of the money, so the deeper in the money, the greater the probability that the option will expire in the money. Because if you remember, when we talked about delta, we also talked about that delta basically can also be understood as the percentage of probability that it will expire in the money. So if 9100 is at the money, right? So we are talking about a call as of now. So can you see we're looking at a call? So if 9100, let's assume, is at the money, you can see the delta is around zero point 0.5, which we talked about. The delta is zero point 0.5 for at the money. And here you can see the Vega is 5.16. But the more we start getting deep into the money, so can you see the 8700 is deep into the money? Because what is the probability that from 9100 we might go to 8700 by the expiry? That probability is low. So that is where you can see that the delta is zero point 0.8, very high delta, because it is deep in the money. So since it will have a smaller probability of surprise, because most probably it will end in the money, right? So this getting out of money, the probability is very low. So that is why when you start getting really deep into the money, you will see that the Vega will start reducing, right? You can see it's reducing as in when we are going deeper into the money. Why? Because now the probability of that surprise starts reducing. So again, the deeper in the money, the greater the probability that the option will remain in the money at expiry, which basically implies we have a smaller probability of surprise. And since we have a smaller probability of surprise, the Vega will start reducing. And the smaller the probability of surprise, the less the impact in change of implied volatility. And that is what we can see here. Now, similarly, if we talk about, okay, so therefore, the smaller the probability of surprise, the smaller the Vega, right? So I've already talked about all these 3 points. Now, similarly, if we talk about going out of the money, so again, you can see we have calls, and this is 9100, and now all these calls are out of the money. So what is going to happen? The deeper out of the money, the greater the probability that the option will remain out of the money. So here you can see this only has a delta of 0.1, which means we only have 10% probability that yes, we might expire in the money. So we are very out of the money for this one, because price has to go 400 points up to make it as in the money or maybe at the money. So the greater the the deeper we are out of the money, the greater the probability that the option will remain out of the money at expiry, which again means a smaller probability of surprise, right? And the smaller the probability of surprise, the less the impact in changes of implied volatility. And that is why the smaller the probability of surprise, the smaller the Vega. So here also you can see the more we are going out of the money, the Vega is getting smaller and smaller and smaller, right? So whether you go in the money or whether you go out of the money, the more you start getting deep into the money or deep out of the money, the value of the Vega will start reducing. Now, if you try to understand it in a very graphical way so that it's easier for you to understand, so let's assume this is my time to expiry. So if we have add the money strikes, right? So let's assume we have at the money strikes of different expiries. So what is going to happen? The one which is nearest, we talked about, will have smaller Vega, right? Because the time value will be small. The one which is further away at expiry will have more Vega. Why? Because now it has more time to the expiry. And similarly, the one which is very, very far away from expiry, because it will again have more time value. So here the Vega will be much bigger. So this is something we just talked about few slides ago. Let me just again quickly show you, and then we'll again come back to this. So can you see when we talked about expiry, the further out we are going to expiry, the bigger the value of the Vega. So you can see the value of the Vega starts increasing. Why? Because the time value portion starts becoming bigger and bigger. So that is why you can see here, if I've taken three examples, the closer we are to expiry, the smaller the Vega, the further away we are, the bigger the Vega, the more further we are, the bigger the Vega. Then we also talked about that the more we start getting in the money, so let's assume if this was an example of call, so we are now getting in the money, deeper in the money, and this is where we are getting out of the money. Similarly, here we are getting in the money and here we are getting out of the money. Here we are getting in the money and here we are getting out of the money. So what is going to happen? You can imagine now this as a kite structure, right? If we draw this. So what is happening to the Vega? So here you can see the more we start going outside, the portion of that Vega starts becoming smaller and smaller. So example, if it is deep out of the money, it will have a smaller Vega. Similarly, if it is deep in the money, it will have a smaller Vega. Similarly, because here by default we are starting with a bigger Vega, and if this starts getting out of the money, the value portion will be getting smaller. Similarly, in the money, the value portion will be getting smaller. And same way here, the more we start getting out of the money, the value portion starts becoming smaller. Similarly, the more we starts getting into the money, the value portion starts becoming smaller. But again, at the money, the one which has at the the farthest expiry will always have more Vega, then smaller Vega, then the smaller Vega. And yes, the more we start getting in the money, the Vega starts reducing. The more we start getting out of the money, the Vega starts again reducing, right? Because the lesser the probability of a surprise, because if it is deep in the money, it will remain in the money most probably. Similarly, if it is deep out of the money, it will remain out of the money at expiry. So this is how it is. So again, if you talk about the Vega effect, if the current implied, now how does Vega changes the value, right? So we have already talked about what will be the Vega of different expiries. We have already talked about what will be the Vega when we are getting deep into the money or when we are getting deep out of the money. And now let's talk about how does the Vega changes the value. So here you can see the current implied volatility of 28th of May is 22.38. So let's imagine this is my implied volatility IV. So this is 22.38 and the Vega is 5.16. So what this basically tells me is that if the volatility goes up by 1%, which means it goes to 23.38, then the value of that option will increase by 5 rupees and 16 paise. So, and similarly, if it drops, so let's take the drop example first. So if it drops by 1%, which is 21.38, the new value of this same contract will be 117.75 minus 5.16, which is going to be 112.59 rupees. And similarly, if it goes up, if it goes to 23.38, which means it moves up 1%, then the new value will be 117.75 plus 5.16, which is going to be 122.91. So this is what Vega tells us, that how much will the value of that option premium increase or decrease given a 1% change in the implied volatility. So if this is my implied volatility, if it goes up 1%, the value increases by 5 rupees. If it goes down 1%, the value decreases by 5 rupees. Now let me just take just to touch upon this, a few recent examples. From the recent expiry, right? So let's take Nifty again, NIFTY. Let's take Nifty. So we talked about three things. The first one was the time to expiry. So let's take example of time to expiry. Let's take example of calls and let's take at the money. So last traded price was 146. So let's take 150, which is going to be at the money. So if I take at the money right here, which is my January, then I'll 7th January, then I'll take 14th January, then I'll take 21st January. So what I'm doing is I'm taking at the money, but different expiries, right? So let's take this one, then let's take 4th of Feb, then let's take 11th of Feb. So can you see I'm taking all at the money strikes, but of different expiries. So what we will be able to see, something which we just talked about. So what we talked about was that the more we are going, why am I not able to add this? Just, oh, sorry, I need to add from here. So what I will be able to see here is that the more we are going further out in expiry, the Vega will start increasing. So can you see the one which is expiring of 7th Jan has a Vega of 3.24, and the one which is expiring on 25th of Feb has a Vega of 20.91, and you can see the Vega is increasing as we are moving further away, or we are having more and more time for expiry. And the reason for that is you will also see that the price would also start increasing. So you can see, because the higher the price, the higher the time value, the higher the time value, the bigger would be the impact of Vega. So that's an example of the same strike, right? But same strike which is at the money but different expiries. Now let's remove all of these, and now let's talk about example of at the money and sorry, in the money and out of the money, right? Let's also take example of in the money and out of the money. So let's say I go for the 28th of Jan, which is the current month. And let's take first the at the money option. So this is at the money. And now I want to take options which are getting deeper and deeper in the money. So if I'm talking about a call, the ones which are cheaper will be getting in the money. So let's take in the money options 50. Then we have 14,000. Then we have 13,950. Then we have 13,900. So now what you will see is, like we talked about, that the more we start getting in the money, the value of the Vega will start reducing. So you can already see a reduction in Vega, but the thing is, I'm still taking values which are, uh, I mean, which are very close by. So let me just take something which is really far away, and you will see a substantial change in the value. So let's say I take the 11,000, right? So let's take the 11,000. So can you see, if I take the 11,000, currently Nifty is at 14,000 rupees. So what is the probability that by expiry, this will convert into out of the money? That probability of surprise is very low. So what is going to happen? The Vega will also be very low. So you can see here it only has a Vega of 2.45. Why? Because it is already deep into the money. So even if Vega changes by 1%, the impact to this option price will not be a very big impact. Why? Because this will only get affected by 2 rupees and 42 paise, because we are already very deep into the money. Now similarly, if we take example of out of the money, right, let's take example of out of the money. So what I'll do is I'll take OTM, and let's take a number which is a little far away. So let's say 15,000. So if I take 15,000 out of the money, here you can see the one which is at the money has a Vega of 13.92, but the one which is deep out of the money only has a Vega of 5.5. So what is going to happen? 1% change in implied volatility will only affect the value by 5 rupees and 50 paise. Right, so this is what is Vega all about. So Vega basically tells you how much the value of the premium of an option will change given the 1% change in the implied volatility. And the best way to remember this is always by remembering these three kites, right? So the closer to expiry, the smaller the Vega; the further away from the expiry, the bigger the Vega. Similarly, the more we start getting deep into the money, the smaller the Vega; the more we start getting out of the money, the smaller the Vega. And that will also apply to all other expiries. All right, so that takes care of Vega, which is one of the most important aspect whenever we are planning options trade, because you will see as we move ahead, we will be giving the highest weightage to the implied volatility, and based on the implied volatility conditions, we will be choosing what kind of option strategies we should be applying. Because, like I said, this is the wild animal, and we need to tame it, and that is why it will have a major impact for us. In fact, this would be the key criteria for us to decide whether we should be buying options, whether we should be selling options, because like I already said, this one single factor can take away all the profits you were making from all other dimensions. So that is why it becomes very important to tame this dimension. All right, so that brings us to the end of today's session. Thank you so much for joining in. And yes, again, I'll add, if you're liking these sessions, make sure you hit the thumbs up button, share it with your friends, share it with your family. If you're on some trading groups, I'll highly appreciate if you can even share it with your trading group. And yes, if you have any questions, queries, feel free to put it in the comment section. I'll try to answer your queries as soon as possible. So enjoy your Wednesday evening. Take care. Bye bye.